Cryptocurrency will keep crashing as long as inflation is high. So in this video, I'm going to look at where inflation is, where the economy is, how the Fed is reacting to that, and then where we are in this current cycle in terms of asset prices. This is the price to earnings ratio history of the S&P 500 over the last 100 years. It gives us a really good outlook as to where we are in the current cycle and how that is going to affect the price of Bitcoin and altcoins over the next few months and years. So I'm going to look at that in this video. Timestamps for everything down in the description as always. Firstly, I want to get to the price of Bitcoin. You can see that this week, over the last week, we had a really nice jump up from the kind of low of 28,500 up to 32,000. That was ironically on the back of some fairly bad news for the economy. But on Friday this week, we got some fairly good jobs numbers. Ironically, that's bad for the price of Bitcoin. Good jobs numbers and a strong, robust economy means that the Fed has to be even more hawkish and tighten, raise rates, tighten the money supply even more to try and basically keep the economy from growing. That's what they're trying to do right now. And so the better the economy looks, ironically, the more the Fed has to do. And that means Bitcoin will actually go down in price. Bitcoin, you can think of essentially like property. During the good times, the price goes up. During the bad times and when recession comes, the price will go down. It's essentially a inverse derivative of the strength of the dollar, interest rates, and the economy. So when the economy is getting worse, ironically, that's when the Fed will lower rates and try and boost things, weakening the dollar, hence Bitcoin goes up. So what we can see here is 30K is still a very, very key level, and we are expected to kind of trade around this probably for the foreseeable future. All of these price movements are based on jobs data and econ figures. Weaker econ figures will see it rise, and then stronger economy kind of output figures will see it go down, basically as a derivative of interest rates, which I'll talk about at the end of this video. So I do see a lot of kind of short-term volatility. If you're a short-term trader, you can trade this. I'll leave the link to Bybit, which is this platform right here in the description. You can get a deposit bonus if you put crypto or fiat on the platform. They'll give you up to $4,000 as a deposit bonus to trade in your futures trading account. So if you trade futures, check that out. You can get a big deposit bonus. Right here though, the price to earnings history of the S&P 500. You can see during the last easing cycle, we got up to historically very, very high figures. This was just the crazy economic collapse in 2008. But we were historically high, and we've come way down now to what you would see as historically neutral price to earnings ratios. Now, what this essentially means is that the market currently now is fairly priced in relation to historical figures. So for the earnings that the market makes, the market is priced in a normal way. You can see June 1, 2022, the price to earnings ratio is around 20. Not massively high. It is higher in recent years, but compared to kind of modern history, 20 is around about normal. It can maybe go down to about a 15 or 16. And obviously when the Fed is easing a lot, you can see it really jumps up here to 40, which is obviously too much. So we have come down, we have tightened, but it can go down further. Right now we're placing the ratio of that we're willing to pay for earnings at 20. So 20 times current earnings. It may go down a few points from here. So you may get 18 times earnings, 17 times earnings. That doesn't really matter. What will hit really hard is if earnings come down, and they very well could. So right now the market is around about priced appropriately, but what could see price fall further is earnings. So the price to earnings ratio may stay the same around 18, 19, 20, but if earnings come down, so will the price of stocks, bringing down the crypto market as well. To complicate this though is the real economy, which is definitely going through a recession right now, at least in tech. And obviously with Bitcoin and altcoins being tech and related to tech, how much of this tightening in the tech market is left to go, and how much will that affect Bitcoin prices? So what we can see here is, Peloton getting rid of 3,000 staff, Twitter freezes hiring, Carvana 2,500 laid off, Netflix laying off workers. Basically all of the fintech plays that got all pumped up, just too much money in the system here. Meta freezes hiring, even Meta. So you can see that the The contraction of the economy is hitting tech first. I believe tech is first into this recession, slowdown, will also be first out of it. That's just how these kind of stocks work. Also, you can see here that this is the monthly global liquidity cycle. You can see during the Fed's easing really, really high, and now we're coming down to normal figures. So everything is normalizing, but now the future outlook is, do we have to tighten even further, or is inflation going to come down? So that's really the key thing. You can see investors here set their sights on upcoming inflation report as the bear market rally falters. Inflation staying high means that the Fed will be extra hawkish. So the economy is fairly robust in the States anyway. But if inflation stays high, the Fed will spark that into a recession. Just to prove this as well, we've seen US 10-year Treasury rates, the yield that is, tick up. And this means the market is fairly afraid that essentially the contraction that's happened in tech needs to happen in the real economy as well. And yields are telling us this. So the jobs report that came out on Friday was fairly good, meaning that they think the Fed has to tighten further and really hit the rest of the economy as well. You've seen rates come up. They actually came off a little bit, but over the last few days, they have spiked here. This is the jobs number right here. When jobs are really strong, that means they think the Fed is going to have to raise rates again to really hit the economy. So you can see the rates just ticking up here. So the market is telling us we don't like these strong jobs figures. We need the jobs figures to be softer. And if that happens, rates will come down because they think the Fed is going to ease again. That's good for Bitcoin. So if you're in Bitcoin, what you really want is a slowing of the economy that isn't really happening here. Next Friday is CPI figures, which is extremely important. If they come down again, then that's very good for risk assets, including Bitcoin. The market thinks that the Fed is going to raise 50 basis points this month, 50 basis points at the next meeting, and then switch it down to 25 basis points a couple of times. This depends on inflation and the health of the economy. But most of the market, as you can see here, is predicting a 50 basis points move this meeting in June. So 97% chance of that happening. That's what the market thinks. Going through to July, again, vast majority of the market thinks it's another 50 basis point hike. And then in September, what you can see here is that the market is undecided. Actually, a lot more people are thinking that they'll go down to a 25 basis points hike right here. This is possible. If inflation stays high, very high, what you'll see is this figure going down and a 50 basis points going up. That's not good for Bitcoin. If inflation comes down and that print next Friday is low and it shows the growth of inflation slowing or either a deflation, then this 50 basis points will not happen, and a lot of people are going to go to the 25 basis points. So it really is figure by figure at the moment, jobs reports and CPI. CPI is the absolute thing to rely on. If CPI is coming down, it is risk on way more for Bitcoin. And so Bitcoin will pump. Some of the altcoins that have been hammered will also start to pump. The scenario that the market is pricing in right now is essentially just a slowdown of the economy and not a recession. And so that plays out into the Bitcoin chart like this, essentially a kind of bumbling around this level, and then go from there. Now, the second scenario is that there is a short, sharp recession, which may happen towards the end of this year when oil prices start going up again as the Northern Hemisphere starts to try and heat their homes again. And so that could bumble around. Then you see a short, sharp recession and then easing of monetary policy, which then obviously sparks another rise for Bitcoin. They're the two scenarios that are in play right now. The market is pricing in the first one, where we're just going to go around this level for a while and then go from there. I do not see a scenario where we just suddenly start going up. I don't see any scenario where that is possible. The economy isn't growing. It's trying to actually come down in terms of its growth, and the Fed wants that as well. So there's no scenario in which I see altcoins or Bitcoin really pumping anywhere like this. These two scenarios are far more likely. A kind of consolidation around here, or a consolidation, then an actual recession, which is a short, sharp kind of shock, and then easing of monetary policy. So those two scenarios at the bottom are really the most likely for me. If you do trade short term, check out that $4,000 deposit bonus on Bybit. I'll leave that link in the description. I'm James with MoneyCG. Cheers for watching, and I'll see you in the next one.